When you sit down to finance a car, a home, or a personal expense, the first number you see is the advertised interest rate. Lenders print this number in large, bold text because a low rate looks mathematically appealing. But evaluating an offer based entirely on that single top-line percentage ignores what lies beneath the surface. To offer that attractive low rate, financial institutions often require you to pay upfront origination charges and discount points. These hidden costs artificially lower the advertised percentage, securing your signature while quietly inflating the total amount of money you actually owe. This visual illustrates the difference between an advertised rate and the true annual percentage rate, or true APR. When we force all of those hidden upfront fees and points back into the baseline rate, the structure expands. The resulting true APR reveals the genuine higher price tag of the money you are borrowing. Manually calculating the true APR across 3 or 4 different offers with varying terms and fees is incredibly difficult on paper. You need a specialized computational tool to process the variables accurately. By relying entirely on rate-only comparisons, you expose yourself to predatory fee structures. The only reliable defense is to analyze the total cost of each offer side by side. To use the MiniWebTool loan comparison calculator, you need to gather 4 specific data points from your lenders. You need the total loan amount, the advertised interest rate, the length of the repayment term, and the exact dollar amount of any upfront fees. Once you have your documents, start by setting up the workspace. You can select your local currency from the drop-down menu at the top. Below that, you will see pre-filled Quick Start templates for auto, mortgage, or personal loans if you want to see a test run. For our demonstration, we will establish a baseline control scenario. We will input a standard auto loan for $20,000, locked at a 5% interest rate over a 48-month term. In this control scenario, we will assume there are 0 upfront fees. Because there are no hidden charges to account for, the advertised 5% rate and the true APR remain exactly identical. As you fill out the first card, pay close attention to the final input field, upfront fees and points. This specific box dictates whether your loan is a straightforward transaction or an expensive trap. Building this clean, fee-free baseline is a necessary first step. It gives you an uncorrupted mathematical anchor, allowing you to accurately judge all competing, highly structured offers against a pure standard. Now, we will input a competing offer designed to test that baseline. We will set loan 2 with a highly attractive Also, stretching the loan from 48 to 60 months lowers the payment, but the sharply upward curving total interest projection line reveals how a longer term inflates total accrued interest. If you have more offers from other dealerships or banks, you can quickly populate 3rd or 4th scenarios by clicking the Add Another Loan button. With your variables entered, review your numbers one last time. Once everything is confirmed, execute the comparison to let the core engine process the conflicting data. Feeding these contrasting variables into a unified calculator neutralizes the lender's marketing psychology. By isolating the math, you strip away the illusion of a low monthly payment and reveal the true financial impact. The results dashboard categorizes the data by awarding 3 distinct trophies. You will see a winner for the lowest monthly payment, a winner for the lowest total cost, and a winner for the lowest true APR. An anomaly appears. The winners disagree. The loan with the lowest monthly payment isn't the cheapest overall. Loan 2's $1,000 upfront fee completely erases the interest saved from a 1% rate drop. The lower payment comes from term stretching, not lower costs. When this happens, the tool generates a dynamic warning text box. It explicitly flags the disagreement, pointing out that a smaller payment is likely hiding higher fees or a longer term. This establishes the golden rule of borrowing. Whenever these metrics conflict, total cost and true APR must always override the monthly payment. Following the lowest payment blindly leads to long-term financial loss. Scrolling down, this stacked bar chart, labeled Where Each Dollar Goes, visually dissects the financial burden of your chosen loan. It separates your capital into 3 layers: the actual principal borrowed, total interest, and upfront fees. Below the chart is the full comparison metrics table. Here, you can perform a granular audit of every variable side by side to confirm exactly where the cost differences lie between your offers. Finally, review the step-by-step scoring breakdown at the very bottom. This logs the exact sequential logic the calculator used to declare the overall winner. Leveraging this comprehensive data breakdown takes a confusing, high-pressure sales pitch and turns it into an objective mathematical decision. You can sign your final paperwork confident that you secured the genuinely cheapest loan.